Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description below. As always, everything today is general commentary only. It doesn't take your personal situation into account. With all of that said, let's jump into our first chart. So going to start off with the S&P 500. And what we've had an all-time high last Friday, and now we've seen a little bit of a pullback over the rest of the week through to Thursday's close. And it's interesting. I did a bit of a count back, and there have been 17 all-time highs since the start of the year, or at least how I've counted them. Maybe, hopefully, I didn't miss any, but looks like 17 new all-time highs over the course of the year so far. And that's the thing. They tend to cluster. These all-time highs tend to cluster. So when the market is running, we often see a series of these all-time highs develop. And the interesting thing is people hear all-time high and they think, oh no, the market's run its course, can't go any higher because it's just hit an all-time high. But as we've seen so far this year, they all-time highs often lead to more all-time highs. Now, having said that, though, I do think there's some cause for caution in the near term. I'll get to that in a moment. But first of all, for people who are already in the market, people who have been in this rally since the market got back up above moving averages and it's been running, for people who are in this market, I think the strategy remains the same as it was last week and for the last several months for that matter, and that is just letting profits run. The S&P 500, it will pull back to these moving averages at some point. There's no denying that, but we just don't know when. And this is the thing with these upward trends. It's second guessing where they're going to stop. It's often not the right play. Often the play is just let them run, see how far they can go. It's a case of letting profitable positions go for as long as possible. And I think we manage the risk of a larger pullback by using trailing stops. So it's all about keeping that upside open when the market's running and then having the exit point or having the exit strategy if a pullback develops into something which is larger. So, of course, we're going to get pullbacks within rising markets. We'll get pullbacks. We don't want to get stopped out of those. But it's when we get pullbacks become something larger, we do need to have our exit strategy in mind. But if you're not already in the market, well, I'm not at all. Look, I'm just not enthusiastic about buying at current levels. It's I just don't think this is an asymmetric at any point. Any which way I look at it, it's hard. Yes, the market could keep rising, and it's not just about could it keep rising, it's about how you manage your risk around that. And I'm just not sure it's asymmetric in its current setup. So let me just put on an RSI, for instance. I want to show you something when we use an RSI on this market. So divergence. So divergence is when you've got rising prices, but you come down to the RSI and the RSI is declining. So it's what we've got bearish divergence. Now, this is something I spoke about back in January. I noted that there was divergence. Nothing came of that. The market kept going. This sometimes happens. The market keeps going and the divergence disappears. The divergence hasn't disappeared in this case. It's become more extreme. So the RSI continues to decline while the market continues to rise. So this is something I don't think can just simply be ignored in saying that, look, the RSI is just not working this time. There is that very clear-cut divergence. I think that this is a sign that we are getting close to the price coming back and retesting the moving averages. So what form any sort of pullback, any potential pullback would take, I don't know. It could be a shallow pullback where it just goes sideways while the moving averages catch up, or it could be more of a zigzag type pullback, which is sharper and less pleasant to sit through. So we don't know. But I suspect either way, we're going to see this RSI make its way back to the midpoint, which is 50, and then potentially lower. Should that happen, it's hard to see how the SP 500 continues to rise. And this is why I especially don't want to chase stocks that have run hard. So I'll give you a classic example of a stock which has run hard, and that, of course, is NVIDIA. Now, this has been the boom stock of the year, basically, and the strategy has been to buy the breakout and let the profit run, continue to let the profit run now. For if I was in this, I'd be letting the profit run. What I do note, though, is the extreme of the situation in that, like, I'm measuring from its high back to the 50-day moving average, and it's something like 26 to 28% above the 50-day moving average. So that is, as far as NVIDIA's history goes, it's extreme. You can measure all these previous periods out yourself. Almost none of them get to that extent. And when gravity does kick in, and gravity always does prevail in these situations, after an extreme move, it does come back to the moving average, and it can be a significant pullback to the average. But go back and look at them yourself and see what happens. Sometimes price comes back to the average and treads sideways. So it's not saying the stock's about to crash by any stretch, but it's saying that the potential for further gains is possibly limited by the extreme distance it is getting from those moving averages. And I'd say that retest of the averages, it is inevitable at some point, and that could tie in with a broader pause, with a pause generally in the broader market. So just something to keep in mind where I say the S&P 500, it's hard to buy it on an outright basis on its own at current levels. And now, look, if you're getting some value from this, please hit that like button. Please leave us your comment. Just, hey, thanks for the video. Just tells YouTube you're watching. YouTube shows other people. Helps me heaps. So please do that. Now, one thing to finish up with, I want to finish up with the Russell. The Russell 2000, the small caps. It hit a new high on Friday this is Friday last week. I'm filming on Friday afternoon in Sydney. So we're yet to see the Friday session in the US. But it's since had a pullback, and the pullback brings it back to the breakout point above this, where this resistance band, which I've had marked on the chart for ages, is. We just compress that a bit. You can see the range that has been in place for something like 18 months, and it was bounded by this upper resistance band taking in these previous highs. So we're just coming back now to the breakout point. So this is a section of the market that I think offers a lot of upside potential. I like the risk-reward dynamics of how this stacks up. The Russell, when you look at it overall, it's starting to lift off a large basing structure. So we've had the down period, the sideways period where the base is formed. Now we're starting to get the lift-off period, but it doesn't mean it goes up like a rocket ship. It can go up, it pulls back, it does work, goes up again. That should this scenario play out. But of course, if we get a pause in the broader market, that's going to naturally impact the small caps as well. I think we want to see how the Russell trades. Now it's coming back to this 50-day moving average. Just seeing what's happened the last few times it's come back. There's been immediate interest in buying that dip. What's going to happen this time we're approaching the moving average? That's going to be an important piece of the puzzle to how this plays out in the near term. Are we going to see that buying interest like we have on previous occasions? And I think that's going to be key to keeping this trade on track in the near term. Can we continue to see this sequence move to the top side? But I think a lot depends on the broader market. If the Russell doesn't find support near current levels, then I think it's a case of stepping back and reassessing as the price action unfolds. Because do remember, this has been a big rally off the October low. Again, it wouldn't be unusual to see backing and filling before potentially moving higher later in the year. And as always, what we're doing, we're weighing possibilities and we're managing risk around those possibilities. There's just, as you know, there are no certainties in this game. It's looking for the pieces and trying to put them all together. So look, let's leave that there for this week. Thank you for joining me. Hopefully it's been interesting, giving you a few ideas. I look forward to coming back and talking to you next week. Till then, bye for now.